Now let's jump into number 4. Readiness statement number 4 says, I know how to leverage my thrift savings plan and other investments effectively in retirement. Now, leveraging your investments is a challenge for sure. Let me also say, I'm not here to give you investment advice. That's beyond the scope of what we're trying to accomplish. But you do need to consider one of the very important pieces of your retirement, your assets, and how will you use them. I think the most complicated thing is we see this TSP asset, $300,000, $500,000, or whatever you have in that account, and it's this bulk of money. Well, what does this bulk of money mean to me as a withdrawal plan for the rest of my life? And that disconnect is quite the challenge. You spend all these years building it up, and now you're going to distribute it. You're going to move from accumulation to distribution. Quite the challenge for sure. So let's go through an example of how your assets can be leveraged into your retirement program. We have here income in retirement. Let's say your pre-retirement income, your bring home pay today, is about $5,600. And when you retire, you're going to have a federal annuity, say of $3,000, $1,500 in Social Security, and TSP withdrawals then of $1,100 a month, giving you the retirement income that matches your pre-retirement income. Now, maybe you don't need that much, but in this example, I want to show how these 3 legs of a retirement stool need to add up to match your retirement income needs, typically compared to what you're making today in income. Now, is a $1,600 or $1,100 withdrawal from TSP sufficient? Are you going to be able to handle that and draw that for a long number of years? Or is that too great of a withdrawal rate and you end up going broke too soon? That's the fear, that's the concern that we see from a lot of federal employees. So again, I'm not giving you a rate of return or recommendation, but an example here next on how withdrawals can work from your TSP. Let's say you have a $500,000 TSP and you want to withdraw it at 4%. That'd be $20,000 in a gross distribution minus taxes. I had to make some kind of assumption, so we'll say 30% by the time we add maybe a federal and a state combo taxation, leaving you $14,000 a year to withdraw, or, oh look, $1,100 a month. So again, that works if you had a $500,000 TSP and you were comfortable with a 4% withdrawal rate after taxes. That amount of withdrawal will help keep you at the standard of living that you're enjoying while employed. So that's the kind of numbers you want to crunch to see if that will hold, and then will a 4% withdrawal rate be sufficient or comfortable for you based on your purposes and goals for that money, both now through retirement and after you've passed away. Hopefully that makes good sense, just the basics of how you withdraw. So what we're saying is your investment strategy needs to match up with your asset withdrawal plan. By that I mean it's typically a difficult thing to have money in the stock market, the market drops down dramatically, and you're taking money out of that account at a rapid pace. Typically that's detrimental to a long-term financial plan. So again, I'm not here to tell you how to invest your money, but do make sure that your withdrawal strategy matches your investment strategy.